Hello friends, welcome back to our channel. In today's video, we are going to understand a very important term in economics and international trade, tariff. You might have heard this word in the news. India increases import tariff or China reduces trade tariffs. But what does that actually mean? Let's break it down in simple language. Types of tariffs. There are mainly two types of tariffs. Import tariff, tax on goods coming into a country. Example, importing cars, machinery, or electronics. Export tariff, tax on goods going out of a country. Example, a country may add export tariffs on raw materials to ensure enough supply remains within the country. Sometimes there's also a transit tariff, a tax on goods passing through a country on the way to another destination. Why do governments use tariffs? Tariffs are not just about collecting money. They have several important purposes. Protect local industries. If foreign products are cheaper, local companies can't compete. By adding a tariff, imported goods become costlier, encouraging people to buy local products. Generate government revenue. The government earns money from tariffs, especially in developing countries where import taxes are a major income source. Control trade balance. Tariffs help manage how much a country imports versus exports, maintaining a stable trade balance. Political or strategic reasons. Sometimes countries increase tariffs to put pressure on another country during trade disputes or political tensions. Effects of tariffs. Positive effects. Tariffs have both positive and negative effects. Protect domestic industries and jobs, encourage local production, increase government income. Negative effects. Imported goods become more expensive. Consumers pay higher prices, can reduce competition and innovation, may lead to trade wars, where countries start imposing tariffs on each other. Real-world example. A good example is the US-China trade war. The US placed high tariffs on Chinese goods like steel, aluminum, and electronics. China responded by adding tariffs on American goods such as soybeans and automobiles. This back and forth increased prices and disrupted global trade, showing how powerful tariffs can be in shaping the world economy. Tariffs and the economy. Economists often debate whether tariffs are good or bad. In the short term, they can protect jobs, but in the long term, they might reduce efficiency and increase costs. Modern trade agreements like the World Trade Organization, WTO, often encourage countries to reduce tariffs to promote free trade and global cooperation. So, to summarize, a tariff is a tax on imports or exports. It protects local industries, controls trade, and generates government revenue. However, it can also make goods expensive and strain international relations. In the global economy, tariffs act like a double-edged sword, helping some but hurting others. And that's all for today's video. Now you know what a tariff is, why it's used, and how it affects trade around the world. If you found this video helpful, please like, share, and subscribe to our channel. Also, tell us in the comments, do you think tariffs help or harm the economy? See you in the next video. Stay informed. Stay curious.